Should be more, but thanks, Jen, for letting me know that it works. Glad you made it today. All right. So I am a little bit dirty and I'm a little bit tired because I've been up since 4:30 this morning, couldn't sleep. I'm doing a huge remodel project here on the property. I'm actually re-siding the entire home and then building on a deck, and then we're working on shipping container, all this stuff. Anyways, couldn't sleep, so went to Home Depot and I was just working outside, but I wanted to come in here because I wanted to make sure that I got a chance to spend some time with you all. So I've got about 45 minutes to an hour, and I got a couple stuff that I want to touch base with you. We're going to go over real estate, the market. Is this the right time to buy, especially as we start heading into this depression? I think it's going to be far longer than just a normal recession for us, and I'll explain more about that in a little bit. We're going to go over the stimulus too and what my thoughts are about that. And if you guys don't know what's going on, I'll give you guys a quick little update. Not much has changed since last week, just FYI for those who are here. And then we're going to go into not falling for cheap stocks. Right now, we are starting to see a lot of stocks getting hit hard, and then a lot of stocks are passing their previous peaks before this whole COVID-19 thing hit. But the cheap ones, I keep on hearing people talking about, get into the airlines, get into the cruise lines, get into the hotels, yada, yada. They're really cheap right now. And I want to talk about that real quick because just like my thumbnail shows, there's no such thing as a free lunch. And when it comes to investing, whether it's real estate or stocks, it's not just a free lunch. It's that you can lose a lot of money. You can lose your livelihood. You can lose your investment. So we'll talk about that. And then last of all, I got a lot of messages about this, is Spotify. And I don't normally value growth companies, and I'm going to do it today. I haven't even looked at it yet. I took a brief look at the financials last week when I had a question about it. But with the Joe Rogan signing onto the podcast onto Spotify, this is arguably a huge game changer for podcasts in general. It could really shift the field, and we'll talk more about that. Why? And then I'll show you why it's difficult to forecast out or value a growth stock. And a lot of you guys or gals who've been with the channel for a while know why it doesn't work. So, but we'll get into it. Okay. With that all said, what up, Jed? I am going to refresh my screen right here because it is not acting right. It's not showing everybody in here. So if I blink out real quick, I'll be right back, okay? Hopefully I can edit this out later. All right, I'm gonna refresh it. Hopefully that didn't mess anything up. All right, I'm back. Now I can see everybody. Hey, everybody. What's up, Jed? So yeah, we're going to jump off. We're going to start talking about real estate right off the bat. So we are heading into a depression. And I could be wrong. And a lot of all the other analysts and all the other famous investors could be wrong too. But when we look at the numbers, when we look at what's happening, the reduction in GDP of the United States, not just for our country, but globally, you look at the unemployment rates, I think we're like bumping right up against 40 million people, which is by far, pure numbers wise, obviously, it's the most unemployment or the most unemployed people that we've ever had. Percentage wise, we're looking at roughly, I think it's just under 20% right now. Could be wrong on that. A couple things to keep in mind is that could fluctuate a lot. First, some of them or a lot of them will be temporary unemployed folks. Like my mom right now, she still works and she's temporary unemployed. So every other week she becomes unemployed, and that's when she claims unemployment. And then she does 1 week of work, next week she takes off. And that's a way for certain companies to still keep people hired on, but not have the expense of payroll. Now, even say like optimistically that out of the 40 million people, let's say optimistically, the economy turns back on, 20 million go back to work. That is still 20 million. Even if it's 10 million unemployed, it's an insane number of folks, especially in a developed country like the United States, to have that much unemployment. Now, how does that trickle down to real estate? Real estate is going to be very different than the stock market, obviously. It's not as liquid. But what's going to happen is that it has to, I call it cooking, fester, whatever you want to call it. It takes a little while longer for real estate to really start popping up. And so if this thing started in like March, middle of March, we're only in May. And I know it feels like so much longer being locked down and everything that's been going on, the news just coming at us like a mile a second. It takes a while for real estate to really pop off. If you guys remember in 2008, 2009, that took about 3 or 4 years of cooking for that to really kind of boil over. And so right now what's happening is there's a lot of folks that weren't really in bad situations. Banks weren't doing the predatory lending that they were doing before. And right now what's happening is I don't think that we're going to see a lot of folks getting rid of property because they have to sell. If anything, people are just going to hunker down inside their homes. But there are a lot of landlords who can't hold on to their properties. And I forgot the exact percentage, but a large number of homes, apartments, multifamily residents are owned by landlords. And a lot of these landlords or homeowners are just individuals like you and I who maybe work a full-time job, and were passed down. I know some friends are like this, some family members. They were passed down a home from a loved one or from a parent or grandparent, or they purchased a home and they moved out of it and they went to another home, and now they have 2 homes or 3 homes and they rent out the previous one or the previous 2. The problem with that, though, is that if that person, that individual, loses their job, or is like my mom and is working 1 week on, 1 week off, and her salary gets cut in half, and now she has 3 mortgages, and 2 of the mortgages aren't getting paid because rent is getting paid, homes have to go up for sale. And if you guys have noticed, how many people in America, it's actually the exact number, a rough number is 40% of Americans don't have more than $400 or can't sustain a $400 hit of unexpected expenses. And so we saw what happened and that's why the United States or the government released that $1,200 stimulus so quickly. It's because they know that Americans basically don't have 1 month's worth of savings saved up or expenses saved up. And that's why it was so crucial to put that out there or to send that out. With all that said, real estate is going to take some time to cook. And it's not going to be coming from the traditional sense like from, I shouldn't say normal folks, but it's not going to be from the casual average American who bought a home, who over leveraged, or, the interest rates ballooning up to like 7, 8, 9, 10% and payments are doubling. There just weren't a lot of interest only, not a lot of ARMs, adjustable rate mortgages out there this time around. Banks are a lot smarter. Banks are healthier. I don't see that happening. But there are going to be some really good deals coming up, I believe, by next summer, probably next spring, next summer, on investment properties. So properties, and when I say investment properties, I'm not talking about just single family homes. I'm talking about anybody who had a home that they were renting out. So think about all the folks that rent in your town, your city, your state. All those are owned by somebody. Okay, an individual. Now, granted, some of them are owned by larger companies and corporations or whatnot, LLCs, but a lot of them are owned by individuals. And a lot of folks are going to be trying to hunker down and keep cash right now. They want cash. And so I see a mass sell-off, either because one, they want cash and they're going to try to get a grab at close to peak levels, right? Or they just have to sell. They have $10,000 in mortgages they have to pay each month, and they can only afford $5,000. And you do some quick math and you see how much they have in savings or how much they're willing to lose. They're going to start cutting expenses pretty quick. I can tell you right now that even though I have the funds to support it, if I had to pay $20,000 or $30,000 in mortgages every single month, but even if I was only getting $20,000, I'm not going to be losing $10,000 for very, very long. I wouldn't want to do that. I would probably cut my losses so I could take that $10,000, get some of my cash back, liquidate it, and then implement it in another area, right? I'm not in that situation, but I'm saying that if I were, I could see how that's happening. Now, with that said, we got to wait a little bit longer to let everything kind of work its way out. The economy's starting to open up. Hopefully we start seeing the trends of unemployment going down. But with that said, we have to let that all work its way out from the eye of an investor. And for us, for those who are ready to invest or who want to get into investing, especially in real estate, we'll talk about stocks here in a little bit. We'll talk about gold and all that stuff too, is that you've got to get ready, get your credit score, fix everything. I can't emphasize this enough. Fix your credit score, get a perfect credit score if you can. People who do or folks who do, you guys are you have so much leverage, and you got such a leg up on other people. You don't need education, you don't need a ton of cash. Just having a credit score, if you're over 27, 28, you have a credit score over 800, you have a huge leverage. if you want to talk about, a lot of folks, they say I was lucky or I was born with a silver spoon in my mouth, which is not true at all. The thing that got me through a lot of stuff is just I have an 850 credit score, 850, 860 or something like that. And it has gotten me into jobs. It's gotten me into loans, into anything I wanted, basically, within reason. So just having that, and I pay way less. Like my car loan that I got last year was like at 3%, 5-year car loan for the Tesla, and like everybody else that I knew was getting like 5%. And it was just because I had a near perfect score. So with that said, I know that banks right now, if you're looking at getting a loan or a mortgage on a home, they used to go, the minimum was 620. Correct me if I'm wrong in the chat, if you guys know this. It used to be 620. Now the new minimum for credit is 670. Okay? Banks are tightening up. Banks know that we're about to go into a recession at the bare minimum. Depression, which is looking more and more likely if unemployment rates stay up this rate and GDP is this low, is that banks know that they have to be very, very, very selective of who they give loans and back during this time, because they know it's not going to be 1 or 2 or 3 years. They're looking at the long run here. And so they're going to be super selective with who they give their money to. Okay. So that's 1 is credit score. 2 is you got to start saving money, and then you got to start training or learning how to find deals, right? Just keep on looking around the area. When I say learn, it's not like I can give you tips. I'm like, hey, this is the perfect a real estate property. You've got to know your area. If you told me Chicago and you say, hey, what do I think about this property? I'm like, it looks cool. I don't know anything about the area. I don't know anything about the taxes. I don't know anything about the zoning. Those are all things that you can learn on your own. And if you can find and train yourself to understand the type of zoning, type of property that you want, the type of tenants, and the best, worst case, and a good scenario, then you open yourself up to a lot of opportunities. And that is exactly what I'm doing right now in my city. Okay, let me check the chat real quick. Grant, what's up? Sorry, the chat's over here, you guys, and I'm looking at the camera over here, and I got this other screen with stuff I want to show you over here. So sometimes I don't always see the chat. Randy, what is up from British Columbia? I love BC. Randy, I used to go there all the time. That was the one place, that was my international travel destination when I was a kid. My parents would always take me up to BC. Jed, spring 2021 is when you will see COVID. Yep, I agree with you. I think right around spring next summer, we're going to start seeing some panic fire sales, or so people who are just trying to get out from underneath some homes and free up some cash. Jen, Kai, do you recommend getting an LLC before buying investment properties? Jen, I absolutely do. I actually, under each of my properties, they all are underneath a different LLC. And so this home that is actually... shouldn't say this on live. I live in it, okay? My LLC rents it to me, and I pay my LLC rent. And basically how that works is that if anything ever happens to you, and you guys know that the United States is a very litigious country, they like to sue. People like to sue. And you just don't know what happens. You can be driving down the road and somehow the sun blinds you. You're driving a Tesla and it bumps into something or somebody and they want to sue you. It really, really, really sucks if you're an individual and you have 2, 3, 4, 5 properties with a lot of equity built up in it with cash flows from rent. Somebody could see that. Lawyers can see that. It's like, hey, that's really nice and juicy. Let's sue them, right? And so by having multiple LLCs and multiple properties, you kind of have like these shields up around your stuff. So on paper, I look dirt poor. A lot of times whenever I talk to my lenders or whomever who's newer to me, they ask for documents and they're like, you should be living on the street based on your assets. I'm like, oh yeah, you have to take a look at these LLCs and look at these accounts and look at that. Because I have everything sheltered away. I pay all my taxes. I do everything right. I have all my insurance up to date. It's just that the properties are held under different names. Does that make sense? So I do recommend an LLC. I recommend talking to a CPA. I'll put my CPA's email later. I'm trying to help him out. He's really really good, and his business is just growing. I'm trying to keep he's like spiking right now, so I'm trying to keep feeding him new clients. But he's awesome. I've been working with him for 15, 16 years. He's a friend of mine too. He's out in Maryland, and he works with anybody and anywhere. He's like remote CPA, but he can help you set up either an LLC, S corp, whatever is best for you in the state or your situation. So I highly recommend it. That's a great question. Okay, so that's what I got on real estate. If you guys got other questions, ask me in the chat. And how's everybody doing? Is everybody back to work? It's not as busy in here today. I've got 8 of you guys in here. All right, stimulus package. I'm sure everybody's wondering what's going on. I got some updates and I've got some food for thought for everybody in here. Okay, so right now the HEROES Act, if you guys remember last week, did get passed by the House of Representatives and it's sent into the Senate now, right? So the Congress, 2 parts, right? We got the House of Reps, who's basically basically it's owned by the Democrats, and then we got the Senate, which is managed and owned by the Republicans, and then obviously we have a Republican President Trump, in the White House. So it's in the Senate right now. They're hashing it out. They have not come to terms, which is very, very clear because the HEROES Act was asking for $3 trillion, basically doubling what we just did. They wanted to do it again, okay? I'm not sure how on top of like the economy or finances everybody is, but $3 trillion is an insane amount of money. And just to do $6 trillion within 2 or 3 months is so mind-boggling. So, of course, as you guys know, Republicans tend to be more fiscally conservative, and they already said that they don't want to do that. It's stuck in the Senate right now. And keep in mind that of that $3 trillion, only about $300 billion is going to folks like us in stimulus checks. A lot of the other stuff is going to other areas, small businesses, large corporations, bailouts, state governments, hospitals, yada, yada, yada. But with that said, they are planning to reconvene in June and discussing this more. And now what I think is that I don't think that we are going to see a stimulus until they start getting some numbers back from unemployment and then from productivity, and if they start seeing spikes in cases and deaths, which I think the right number to look at is hospitalization rates. It shouldn't be looking at just new cases because we are testing more often now. Every state, there's so many different ways of testing. I don't think you should be doing off of just the testing numbers. I think you should be looking at hospitalization rates and death rates. But with that said, I don't think they're going to make a decision because Republicans don't want to pull the trigger too fast. And the reason behind that, and I believe both parties are at fault at this, is that our deficit and our debt is so outrageous right now. It's insane. I took some numbers here for you that I'm going to share with you in a second. But both parties have done a horrible job of managing our debt and managing our finances as a country, okay? So I'm going to run some numbers here by you just to give you an idea, and I'm going to talk to you why this stimulus and why all this money, all these trillions of dollars going out to the economy might feel good right now, and it might stave off a big, bad depression, but how it's going to make things a lot worse down the road. So we can either have things easier now and have things really, really hard down the road, or we have things hard now and then it starts to ease up later down the road. Those are really the 2 options that we have. And obviously, the one that we always choose is how do we fix stuff right now, and we just kick the can down the road. So right now, our GDP, the gross domestic product of the United States, basically how much value we put out to the world, is about $21.4 trillion. That's a lot of money, okay? That would almost wipe out our debt, which is at 24.95. We'll call it $25 trillion. That's our debt, 25 trillion. And then our budget though, okay? So our budget, the federal budget, the government, so think about NASA, defense, education, that type of stuff, right? Is $4.4 trillion. This is where it starts getting interesting, okay? Our budget is $4.4 trillion. The income of the federal government is only $3.46 trillion. So the government makes 3.46 trillion, but they spend 4.4 trillion. And then we have a debt of 25 trillion. So to put that in perspective a little bit closer to us is like, imagine you making $34,000 a year, but you spend $44,000 instead, and you have a loan of $250,000. That's kind of the equivalent of it. Okay. And you don't ever cut spending costs. You just keep on overspending. You spend more than you actually make. Now, to be fair, if I were the US government, or even in my case, for example, so let's say that I have the cash to pay off all my loans I have right now. So I have like a small credit card because I'm buying stuff for the house. I just put another $2,000 on my credit card, but I got 2% back. I've got 20 something thousand left on my car loan. I think those are the only two that I have right now. Yeah, just credit card and then the car loan. And why don't I pay it off? I could pay it off, but I don't, because my interest rate for the credit card is 0%, basically. And then the one for my car is 3%. And I know I make more than 3% by keeping that, let's call it $25,000, by keeping that $25,000 either in the stock market or I use it to go buy real estate or whatever it is that I do with it. I know I make more than 3%. The average interest rate of the US debt, I don't think a lot of people know this, is about 2.6%, 2.7%. That's not too bad. The GDP, the normal growth rate of GDP, it's obviously negative this last couple months because everything was locked down, is about 2.5% to 3%. So as long as your GDP is growing as fast or faster than your interest payments, it's kind of a wash. You guys get what I'm saying? It's not good. It's not ideal, but it's kind of a wash. So I see what the U.S. government is doing. I don't agree with it. They could do a better job of dealing with the budget, but it's not a horrible situation that everybody makes it out to be. With that said, the problem with printing out so much money in such a short amount of time is inflation and deflation. Both are really bad. Deflation is obviously the cost of goods goes down, and then inflation is cost of goods goes up. It's just who do you want to hurt? When deflation occurs, it's good for us, right? Consumers. Bad for, let's say that you owned a store or a salon or a bar or a restaurant or whatever, and it cost you $12 for a plate of food, and now you can only charge $8, right? It hurts your margins. But if inflation happens, right? If it used to be $12 and then now it's $16 and we have to pay $16, it's bad. It's just, is it bad for the consumers or is it bad for the providers or the suppliers? And right now what we're going to see is we could see deflation. But here's the problem, is that there's a lot of money going into the economy, $3 trillion, that's already happened. And nobody's really spending money. You and I, we're not going out buying cars, we're not buying jewelry, we're not going to the movies, we're not spending our money. So it's kind of tightened up, it's holed up right now. It's like me giving you $1 million and you bear it in your backyard. It's not really getting implemented. So it's not inflation. The problem is if they print out another stimulus, and they probably will if the economy doesn't get better, I'd say by August, July, August. And by better, I mean saying numbers start looking better. GDP starts going back up, unemployment rates go down, and cases of the coronavirus goes down too. Is a couple years down the road, we're going to see crazy inflation. Okay, I want you guys to go, and you guys get a chance, go and study the 1980 depression, the 1980 recession, okay? It was when the U.S. government actually intervened, or not the government, sorry, the Federal Reserve intervened because inflation was growing so quickly. Inflation usually grows at 2.5% to 3%. Once it starts going to 4%, 5%, 6%, they start getting really scared because you can start falling into hyperinflation, and that's a horrible thing that nobody wants. It's like when you see those pictures of people with wheelbarrows of cash trying to buy bread. And we think that can't happen to us. The reason why it doesn't happen to us is because we have a Federal Reserve. Okay, so what ends up happening is that in a couple years, in 5 years, and this is what we can plan into our investment strategy and everything too, is that $6 trillion, or let's say we know $3 trillion for sure right now, but let's say the potential $6 trillion that was all printed and shoved into the economy, Once people start getting back to work, let's say that unemployment gets down to a manageable range within 36 months, 3 years. People start spending money again, right? We start buying cars, we start buying watches, start going on cruises, start going to Disneyland again. That $6 trillion starts flooding the market. So what happens now? We have all this money that entered the market and all this money being spent by the market. Inflation starts to grow. Now it's not growing at the typical rate of 2 to 3%. Now it's growing at 5%. Now it's 7%. Now it's 9%. And when inflation gets that high, the government and the Federal Reserve, they freak out because they know hyperinflation is a real thing, and they immediately will throw up interest rates as high as possible to curb it. So in 1980, correct me if I'm wrong for those who know more about it, is I believe that right away the Federal Reserve doubled interest rates. So it went from like 4 or 5% and went up to like 9%, just like that. Okay? Can you imagine getting a mortgage at 9%? Do you know what that means for your credit card interest rates? Credit card interest rates would be like over 30 or nearly 40%. Probably like 35%. Okay, so now if inflation gets really bad because of the $6 trillion, there wasn't no $6 trillion back in 1980. There's $6 trillion potentially now. We could be seeing interest rates above 10%. Imagine buying a home, and I remember my folks bought a home at this rate, at 12% interest rate. You know how insane that is? 12% interest rate for a home. For a $100,000 home, you're paying $1,000 a month just on interest. It's so insane. So imagine like whatever your home payment is, right? Whatever your mortgage is, it would basically triple or quadruple, essentially. So something to keep in mind as we get into this, and what I would suggest, or I'm not going to suggest anything. I'm not telling you what to do. What I'm doing is I'm trying to figure out where can I get the cheapest money. So I've got a bunch of, I've got a $500,000 HELOC already pulled out at a 3% interest rate for me to use if I need to use it. And then I am looking at multifamily homes. I'm looking at properties. I'm looking at land to purchase now where I can lock it up for a lower rate, and I have hard assets that I can hold on to, especially riding out through this depression. Okay, typically depressions last about 8 to 10 years. Okay, it's not gonna be all gloomy and everybody's gonna be starving and stuff on the streets. It's not gonna be that. I don't think it's gonna be that bad. I really hope it's not that bad. But what it will be is just it's gonna be a depressed economy where GDP is not growing. There's gonna be high unemployment, and there's gonna be a lot of government intervening. So, all right, questions about that? What's up, Juggernaut? What's up, Sean? I don't understand how some of these YouTubers have so many of them don't have the knowledge really. Yep, you guys are all OGs. Hey, by the way, I never said thank you for the 10,000 subscribers. I think we're over 11,000 right now. But yeah, I don't understand the YouTube algorithm. I'm trying to make my videos better for you guys every single time. I'm not saying that I'm an expert at anything. I do have good life experience, I think. And I've been somewhat successful in the endeavors that I've taken after, and I hope I'm providing value. So if you guys ever have questions about me or my background, let me know. But that's really cool. What up, John Doe? Okay, so any questions about that? The stimulus, inflation, deflation, stock market, investing. If you guys can, anybody who owns a home right now, I would say lock in your rates right now. Get your 30-year fix, lock it in right now. Obviously, prices, we haven't seen prices. Oh, I get this question a lot too. If you should buy a house right now, your primary home. I would say if you're in that situation, I'd say go buy a home that has the potential of becoming an income property. And what I mean by that is that you have at least 2 places that you could live. So like, for example, a lot of people make I wouldn't say mistake. It's a different mentality, or it's a different type of philosophy. But I always want to look for a home, especially my primary home. Is like, can I live in one place and can I rent out another? So is there a guest home? Is there an ADU? Is there a basement? Is there a loft over the garage? Is there some place where I could live and somebody else can live? Because when you do that, immediately you slash your mortgage rate or your mortgage immediately by like 40 to 50%, sometimes even more depending how nice the property is. And so that's what I say first. And I would say and emphasize, if you can get a loan today for under 3%, even at 3%, 3.5%, let's get crazy, and you have to pay a little bit more, it's better for you to buy a home let's say at $500,000 at 3% than it is to buy a home at $400,000 at 8%. You guys see what I'm saying? So what I'm saying is, like, if you have the ability to, I would say within the next 12 to 18 months is a time that you should be getting your stuff together and purchasing a home based on what I see and what I know. And that's what I'm doing. All right. Always learning. What is up? Taro TV. You are buying Bitcoin? You know what? I talked about Bitcoin a couple of weeks ago. By the way, welcome back, everybody. This is our 4th live show. Thanks so much to you for you guys. Gosh, I can't talk today. I'm going on like 4 hours of sleep. Sorry. For anybody who just came in here, I've been working outside, doing a remodel project. I'm still in my work clothes, so brain's a little bit foggy. I've been at Home Depot all day, so I am very interested in cryptocurrency. It is. I'm releasing a video next week if I have time to edit it. With how to split up a stock portfolio. So you have a little line at the bottom where you have a stock portfolio where you do super high, like, gambling stuff, right? Really crazy stuff. Bitcoin is in that category for me. I'm going to start buying Bitcoin. I am. I really am. And I know if you guys watched my previous videos, I hated Bitcoin. I talked down about Bitcoin. I thought it was the worst thing possible. Did a little bit more research. Still studying up on it. Still don't know a lot about it, but it's starting to fall into the category of maybe I should buy it. And the reason behind that is called asymmetrical risk. Or is it asymmetrical reward? One of those two. All right. And what it says is that the upside far exceeds the downside. So what is it trading at right now? You guys know? It's like $9,000 Bitcoin right now. Okay. So $9,000. In 20 years, will I miss $9,000? It would suck. Don't get me wrong, it's a lot of money, but it's not going to make a substantial impact in my life to lose $9,000. But in 20 years, what if that one Bitcoin was worth $100,000 to $1 million? Could that have a substantial impact on my life? The answer is yeah. $100,000 to $1 million is a lot of money, no matter how you cut it. Even if you take it in inflation, $1 million 20 years from now is still $1 million. You all right? So that's called asymmetrical. So one side's way better or way worse than the other side. And so that's what's got me going in Bitcoin, because I don't see any other direction that we're going. We're definitely not going back to a gold standard unless we have like a massive reform in the government or something. And everything is pointing towards digital currency. Everything is, right? And especially, if you guys don't know this, China is completely committed to basically surpassing the United States as the #1 economy. They have it in their plans to do that, okay? It's part of their government mantra, basically, is they want to overtake the United States, okay? And they've already said, we are in the midst of creating cryptocurrency. Or is it cryptocurrency? No, I'm sorry. They are creating a digital currency for the Chinese currency, all right? They could be using blockchain technology. I'm not 100% sure on that. I'll check in on that and let you guys know. But the point is that they're working on that. They're doing that. So they're not going to have paper money anymore. It's all going to be something very similar to Bitcoin, and the Chinese are going to use it. The reason why they want to do that is because right now the US dollar is used about 70% of the time around the world. They want the Chinese dollar. Well, I don't know what the Chinese dollar is. It's not the yen. That's Japanese. The yuan? Y-U-A-N. I think that's the one for China. They want that to be used. But I think if China does it, the United States has to do it, right? It's kind of like one country gets a nuclear weapon, the other country has to get a nuclear weapon, and digital currency would be the equivalent of that. So yeah, I'm looking at Bitcoin. Do you think interest rates will skyrocket long term? I just talked about this. Paradoximus is that, by the way, if you guys want me to call you by your actual names and not call you by your watch me fumble over your screen names, just write your real name in there. I'm just kidding. I don't have a good memory, but I'll try to have a good memory and I'll try to remember your name. Yes, I just said that with inflation coming up, interest rates are going to skyrocket. You can't shove $6 trillion into economy and not expect to see some sort of inflation. And so we will see inflation, not right now, because obviously they're trying, the Federal Reserve is trying to stop the bleeding right now, like the pain of the economy. And so, but all that money is going to come out pretty soon once people start spending, whether that's in 3 years or 5 years or 6 years. We'll definitely see much higher interest rates to curb off inflation. So the one way to curb off inflation is higher interest rates. And the reason why that works is because people will stop spending the money. That's all interest rate does. Interest rates, think about it like a lever or like a dial. The higher inflation, the higher the interest rate is, the less people spend. The lower the interest rate is, the more people spend. And that's just the knob that the Federal Reserve kind of plays with. And then they push the button to print money. They basically have two things. They have a button, print money, and they have a knob for interest rates. That's all they do. And they just sit there doing this. All right. Ghost, I love you. Thank you. Kenny, what's going on? I hope you're not worried. I mean, we should be worried, but it gives us, for everybody in here right now, you guys are doing a substantially, sorry guys, my brain is so foggy, 4 hours of sleep and working out in the sun. You guys are substantially ahead of the pack when it comes to people who are trying to better their lives, whether it's financially, mentally, emotionally, or intellectually, okay? Right off the bat, you're already there. And so when we have these bad cases, recession, depression, we can find opportunities in it. And I happen to, you guys know, who watch my videos or channels, like off of the last recession, the Great Recession, I was able to quit my day job. I quit it 2013, right? So yeah, I was able to basically go through the recession, Great Recession, come out the other end, and basically quit work. I still work, but you guys know what I mean. Quit my day job. All right. It's 8,900 right now. Yeah, it's been fluctuating. I wish I'd bought into Bitcoin at when it basically dropped down. What was it? It was like a 3,600 back in March when the whole thing dipped. But thanks, Jen. You're right. It's the one. RMB, always learning. Thank you. Government printing money equal at high price of Bitcoin. Yeah, that's true. That's one thing I love about Bitcoin. One last thing, and then we'll get on with the live stream here, you guys. I can't stay on too long. I have to work. I got machinery and I got stuff rented out, and they basically charge by the day. And so each day that I don't use it, it costs me several $100s. So I want to make sure I use it. But real quick about the Bitcoin, the really cool thing for folks that don't know this, and you guys probably all know this because I'm late to the game here, I'm late to the party, is that Bitcoin is limited, meaning that there's actually a set amount of Bitcoin that will ever be, is it called mined? I think it's mined, right? And I believe that number is 21 million. You guys are way more versed in that than I am. Tell me if I'm wrong. But basically, and that mining rate basically gets halved every 4 years. And we just had the halving, it was a couple weeks ago, right? So every 4 years, there's a halving. So whatever rate Bitcoin is being mined at, it gets halved. And this also hurts the whole industry, like Nvidia and like all those miners and stuff, because you can't mine. It takes so many resources to actually mine a Bitcoin. So, but what I really like about that is that you can't just print or make more Bitcoin. It's going to be stuck at 21 million. And that's why you have that asymmetrical risk. Once Bitcoin gets stopped at 21 million, the value of it is really just dictated on who wants it, because there's only going to be 21 million. And now the other thing on top of that is you guys got to remember, I remember this. I used to play Diablo 2, back in the day, 2003, 2004, and you can buy stuff online. So you can buy like a sword or a shield or whatever you want with Bitcoin. And it was like cents. I remember it being like, it was like 30 cents. It was something ridiculous. An entire Bitcoin was like 30 cents or like 10 cents or something super dumb. And I thought it was the dumbest thing. I didn't do it, obviously. But a lot of people did. Just they played with it. They bought a couple for $1. They bought some so you can buy a weapon, and they stashed their wallet or whatever it was called at the time. And it was lost. Right? So they think as much as a quarter to a third of Bitcoin is just gone. It's just lost. Like 2 to 3 million Bitcoins are just gone. People got rid of their computers. They lost it. They don't have their code or whatever. So, and then another large chunk is owned by a very small group of people, which leaves a smaller chunk for the masses. And so you're talking about even a smaller supply, a very limited supply, which could help the value. The only problem with Bitcoin is that it's not readily available. I can't go and just go buy a house or buy pencils or just like day to day using Bitcoin yet. So once I can just have a credit card and I just use it, and I know that my bank account or my Bitcoin account isn't going to fluctuate by 30% day to day, I'll be all in. But that's kind of defeats the point of speculating. Okay, last couple questions and then let's jump over. 21 million ever. Yep, thank you. Mortgage rents out of room. I'm going to buy more. Has the best time. Yeah, Toro TV. That's awesome. Great house hacking. That's how I got started too. That's exactly how I got started. Best time, I'd say right now you got pros and cons. You've got crazy low interest rates, but prices are still relatively high, right? Near peaks, not always, but up there. And then in a couple years, 100% for sure, interest rates are going up. I can tell you that 100% interest rates will go up. How high? I'm not sure. I'm guessing, if I had to bet on it, I would guess that interest rates are going to go very high, meaning I'd say close to 10% over the next 5 to 7 years. Okay? And so no matter if prices drop significantly, even if you have to pay, say, 9% on a home, you might as well have just bought it now for $500,000 at 3% than at $400,000 at 7, 8, or 9%. So I think the little window of time that's going to be perfect is going to be in about 12 to 18 months. It's going to be the perfect time when you still have super low interest rates, people have to get out of their homes, and prices are going to go down. All right. Proof of work. Hey, Cedric. Nice to meet you. Jen, what are you talking about? What's POW? Proof of work? My memory is so bad. Is that something I was talking about? Some people mine other coins, and those coins are exchanged for Bitcoin. Yeah, if you can buy it. You know what? Right now, actually, if you guys can buy cash, if you have the cash, I actually would tell you not to buy cash. I would say that we're going to get into this a little bit. There's a time where interest rates are so low, you want to weigh the pros and cons of either letting somebody else hold on to that money. So that's in the case of the bank, if you buy the house no, that's not true. You'd be putting all your cash into the asset. Or if you have a substantial large down payment, let's say that they only require 10% down, but you put down like 50% because you have the cash. You have to go the pros and cons. Is it worth it? Can you do better than 3%? And the reason why I feel like I've been financially successful for my goals, for what I've done, is because I didn't follow the traditional method of, paying off a home, doing this, investing a little bit in the stock market, plan on living off 4% of your retirement fund when you're 65, yada, yada, yada. Is that I've always played the game where I got really good at something, and every 3, 4, 5 years, I'd make 4, 5, 6, 700% on my money, right? And there'd be years I'd be like at -2, -5, -10, plus 700%. -2, 2%, 1%, plus 350%, right? And it's a totally different way of investing. And that's what I've done for myself. I'm not saying this is for you. But part of that strategy is that I needed cash, or I needed money or liquid assets to fund my projects. And so I don't think it's the greatest idea for me, maybe it is for you, to take, let's say that a home is $250,000, to take $250,000 in liquid asset or liquid cash or liquid asset cash and hand it over where now I can't access that $250,000 without going through a loan process and everything. Does that make sense? Because let's say that you're paying 3% on that $250,000, but it gets paid off if you rent out a room or you rent out the garage or you rent out your the basement or something, right? They can pay your interest payments. And then you can take that $250, and let's say that this stock market tanks super hard. And we've been talking about strong companies that we all know that are going to be just fine. It's just a sucky economy right now. and you can buy into a Disney, you can buy into a Microsoft or an Apple or a Facebook or whatnot, whatever, right? Strong companies that you can buy into and get out of this depression, getting gains of 20, 30, 40, 50, maybe even 100%. Does that make sense? So, but there's a balance. You got to figure out what you feel most comfortable with, and then what strategy you want to implement. I know a lot of people would never want to do my strategy, and I would say I would not encourage my strategy on anybody, on a lot of folks, because I know that it's going to be hard for them to spend 4 or 5 years having negative returns because of inflation, and then banking on that you'll get a plus 500% in year 4. What up, Manuel? I feel like I never say your name right. Manuel Chavez, Mr. Chavez. Okay. Any questions about that? All right. So we talked about, let's see. So just to recap, we talked about the real estate market. We talked about, cheap stocks. Okay, cheap stocks, and we're going to go into Spotify. If you guys don't know, Joe Rogan, by the way, not to toot my own horn, I was listening to Joe Rogan back in 2012-ish, before he was popular, and everybody just knew that he was the Fear Factor guy, and he was in his basement talking to Red Band all the time, and he's completely blown up. And now every one of my friends that made fun of me for listening to Joe Rogan now are avid fans of his and probably listen to him more than I do. But anyways, if you guys don't know, he just recently signed an exclusive deal with Spotify, which is a huge deal. We'll talk about that in a little bit. And then we're going to value Spotify. And I'm going to show you why we don't typically value growth companies or value them the way that I'm going to show you how to value it, okay? But we can still get a good idea, hopefully. Hopefully we can. But first thing is don't fall for cheap stocks. There's no free lunch. I almost completely forgot about that. And this was the whole point of this whole video, this whole live stream. There's a lot of cheap stocks out there. Right? We go to Norwegian cruise lines. We've got Marriott Hotel, Hilton Hotel. We've got Disney. We've got another one. The airlines, Delta, Southwest, United, Alaska. They're all getting basically just destroyed right now in the stock market. I think they're down like almost 50, 75%, some of them. And what I hear a lot, and I see this on YouTube all the time, is people just like telling you to buy in, don't buy, buy in cheap, get this. The problem is that I've only met a few YouTubers or seen a few YouTubers actually talk about the fundamentals of business. And the way that I value these stocks is the same methodology that they teach at Harvard Business School. Is if I'm about to buy a private company. So if, let's say, let's pick somebody out there. Jen she has that's right, Jen, I think you had the car wash, right? I would value her company the same way that I'm teaching her. I'm showing you guys how I value these companies, right? You go through the cash flows, you look at the expenses, you common size them, you look at growth rate, you look at past years, you look at future years, and then you come up with a valuation. Now, we can argue, debate, hey, I disagree with this assumption. You should be using a 5 multiple. You shouldn't be using a 2 multiple. You should be using a lower discount rate. That stuff we can argue and we can debate about. The valuations that you see everybody else doing is not that. They use valuations, they use methodologies that are, it doesn't focus on the core business or the business itself. It focuses on earnings, which is then compared to other companies of like, and then compared to the market, and then compared to their industry, and then potentially what's the trade volume, what's the volatility of the market, what's the beta, what's the book value, right? And yeah, we use that as comp sometimes in the private sector and when you're trying to analyze a business. But at the end of the day, in any type of business, ask any type of CEO. Well, I should take that back. Not any type of CEO. Any sound business-minded man or woman, what do you look at when you look at purchasing a company? And the bottom line is its potential is obviously one, right? But it's the growth rate and how well that company is being ran. And a lot of people don't do that. They're just look at this. The price or the PE ratio is so low right now. We should go in. I'm like, yeah, but how are his expenses? Did you see that the marketing expense has been going through the roof? They've been spending a ton of money buying customers. That's why you're seeing such good earnings. The minute they stop spending money on marketing, earnings dries up. But they don't see that because they're just always looking at PE ratios. And it frustrates me. So anyways, when it comes to the one I want to focus on is CCL, which is Carnival Cruises. And I see a ton of YouTubers talking about buying in cheap because they're going to bounce back in X number of years and you'll make a ton of money off of it, which I don't think you will. If anything, you'll make maybe 2 or 3 times your money back, which is not always the best risk. But like, let's pull up CCL real quick. I know you guys can't see my screen, but I'm just going to do this real fast. I just want to see what they're trading at right now. I haven't looked at the details yet. So they're trading at $14.46, and their 52-week high is $54. Okay. Now, when you call a company cheap, just because it was trading at $54 and now you can buy it for $14 or let's say $15, that's not cheap, because the cheap means that you go in and you actually value its cash flows, you value its growth rate, you value its ability to survive the depression. Right? So even if I was like, hey, you can buy this for $2, right? You're like, oh, great. Okay, I'm going to take $20,000 and I'm going to buy, 10,000 shares. Awesome. And I was like, by the way, they don't have enough cash to survive the next 4 months. That changes things, right? Because if they go bankrupt, you have zero. And I think a lot of times what folks happen, they forget is they see a really low PE ratio. And for those that don't know, PE ratio is price to earnings, price of the stock to the earnings. So for basically it's asking for every dollar that company makes, how much is the market willing to pay for it? So if that company, let's just use Carnival cruise ships, for example, if they make $1 right now, what's their PE? Sorry, guys, I should have had this pulled up. Their PE earnings, right? It's 5.3. All right. They used to trade as high as 24 times earnings. So for every $1, they would get the market would pay them $24 for it. Now the market is paying $5.36 to be exact for every dollar Carnival Cruises makes. That's cool. That's really cool. Okay, awesome. It looks cheap, right? They used to trade at 24 times. Now they're at 5. The problem with Carnival Cruises that a lot of people don't know is that they're a Panama company. Panamanian? Sorry, don't know how to say that. They were a company that was filed in Panama. And the reason why they did that is because they have a lot of international employees on the cruise ships. And by doing that, they can pay lower than minimum wage when they're in international waters. Because if you are a U.S. vessel, U.S. company, you have to adhere to U.S. labor laws. But if you're in Panama, you don't have to. So the accountants, the lawyers, yada, yada, yada of this multi-billion dollar company probably got raises and such for coming up with such a brilliant idea, right? The problem behind that is that $3 trillion that was meant to bail out industries and companies, they are only meant for U.S. citizens and U.S. companies. So what's happening is that companies like Carnival, who were super sneaky and tried to operate in the U.S. but were headquartered in other countries, are not getting bailouts. And I don't think Panama's government is going to be giving them a bailout. So that's another big problem, right? And so we'll do this super fast. I'm going to take a look at, maybe I should start sharing my screen with you guys so you can see what I'm doing. I'll do that real quick. Hang on, folks, so you guys can see what I'm doing. All right. Let me make my screen real small. I'll put myself up in a corner. Boom. All right. So I'm just in Morningstar. I want you guys to get used to doing this, so I should make it a habit showing you guys. Let me close this out. Boom. Boom. So right here, if you look at their financials, let's go to the they've got $1.35 billion. They have $14.4 billion in debt. Okay, so their cash is nowhere near how much their debt is, and we know that their income is basically a big fat zero right now. I can't really think what their income would be or where it'd be coming from, but they're normally making 21 billion a year. Okay. With, let's see, their margin. So their net income is about roughly 12%. 12% of zero is zero. Even if they made, let's say that they were let's say that they made half of that. So if they made even 10 billion, they're looking at only 1.2 billion. Yep, 1.2 billion in net income. I don't think that's going to service this debt. It's not even there, but they're not going to even come close to making half the revenue this year. So that's something to think about. And so what I see people doing is that people are spending. They're like, oh yeah, I can take $10,000, I can take $5,000 out of their, $5, $10, $15,000, $20,000 portfolio, and they put a substantial amount of money into companies like Southwest, Delta, United, Alaska, Carnival, Norwegian, Hilton, without really looking at the numbers and the story behind it. They just see it's cheap stock. They're only trading at 5 times PE ratio, or like they'll come back. The problem with that is that you can lose all of it, right? Like we just saw this with Hertz Rental. They just claimed bankruptcy. I wonder what their stock is at right now. Sorry, was it Hertz or was it Avis? I think it was. Nope, Avis is fine. It was Hertz that claimed it. I don't think Hertz is Hertz even publicly traded? No, I don't think they are. That's not them, is it? Can't be. No, it's not. But basically, essentially, they just claimed bankruptcy. So what that means is if that was a publicly traded company like Avis, it would go down to zero. And so you could lose out on all that money. And so basically, whatever your portfolio was, because you thought you could get in cheap, but without knowing the backstory that, hey, it's a company headquartered in Panama, and they are not getting any bailout funds. And they've got zero income for the next 12 months, and they have enough cash for 4 months. That kind of kills the investment right there. So don't get lured in by cheap stocks. Even if the price looks super low, immediately you have to go and look at the books, do your valuations, and then decide. Okay, let's get to this. Let's jump into Spotify. So who here uses Spotify? I used it for a while, and then I don't know, you guys. I'm not that into music. I love music, don't get me wrong, but I'm not that into music. All right, let me get this divvied up here so you guys can see this. All right, so what we're going to do right now is, for anybody new to this channel, is we are going through how to value a stock. And the method that I use, the exact name of it, the boring name, is called discounted cash flows. Unlevered discounted cash flows. And so let me just set this up real quick. So what I do is I have this little cheesy spreadsheet that I use, and I am not an Excel wizard by any means, but I know how to use it at an okay level. We're doing Spotify. Is I set this up where I can pull numbers from the financials of any company, and it will help me price out the company. I value it, and it's valued based off of their cash flows. How much cash can the core business create? So I take out a lot of the hey, we made $2 million in interest from the money in our bank account, and then we made another $3 million because we invested really wisely. But our core business is making burritos. It's like, I don't care how much you made off interest. I care how much you made off making burritos, because interest can change, right? You can make a bad investment next year. I don't really care how much you make. I want to know how much money your core business makes. And then I want to know how much money or cash flow flows in and out of your bank account. And then that's called unlevered free cash flow. The second cash flow is called free cash flow to equity, which means I want to know how much cash flow goes in and out of your bank after your interest or your debt expenses, okay? And that's how you see if a company is really viable. A good example of this is, I'll show you this real quick, is Caterpillar. I'm actually really interested in Caterpillar because they're a solid company. But the problem with them is, if you guys take a look right here, highlight it, boom, boom. Everybody can see this okay? Hey, what's up, Gen F? Is that Caterpillar is a really strong company, right? With good growth. Obviously, 2019, they got hit kind of hard. you guys can see down here where I'm highlighting. I'm not sure if you guys can see my cursor okay. But they were growing at almost 20% year over year for 2 years, 2 solid years. And then they were going into 2019, they got negative. But look at their unlevered free cash flows. They're making what? Almost 8 billion, 5 billion, 5 billion, 5 billion, 6 billion in unlevered free cash flows. You go drop down to how much they make after they pay their interest payments and paying the principals on their debt. And then all of a sudden they're in the negatives. And that worries me, right? It's like, well, how come you have 5 years in a row of negative cash flows? How are you doing that? And you find out that they're just pulling out more debt or they're selling more shares. So one thing for you guys to realize is the reason why it's so important or why it's so dangerous for a company to have negative cash flows. Obviously, if you have negative cash flows, right, it doesn't make much sense. The problem with companies, though, is that they can fake like, what do you call it? Fake it till you make it. They make negative. They have negative cash flows, but their stock prices go up, and that's from 2 reasons. One, they pull out more debt, and 2 is that they sell more shares. And by selling more shares, because of this share, what's Caterpillar is selling at they're sorry right here. They're selling at $112 a share. So $112 a share. If they release, let's say, 1 billion shares, they just got 112. They wouldn't do that. It would completely destroy the stock. Let's say they have 1 million. If they sold 1 million shares, they would get $112 million. They use that to fund their operations. And that's how these companies, that's how they fund these negative cash flows. And so in the long run, it's a poor investment. Even though I have them priced out at almost 170 a share, I'd have to dig into them. A little bit more, but I don't like the fact that they're not cash flowing right here, which is going to be very similar to Spotify. So let's jump into Spotify here real quick. Any questions yet? No? Okay. If you guys have questions, just jump in. So Spotify, as I pull this up and I get everything going here, there is a man named Joe Rogan, who actually is the reason why I got into jiu-jitsu like 7 or 8 years ago. But he has this podcast, this little tiny podcast that started off in his like basement that he went with his, this dorky high friend that I really hated at the time, but now actually really like, named Brian Redband. And the two of them started something. They just started off talking about like Bigfoot, getting high, jiu-jitsu, fighting, comedy. And he slowly started interviewing his friends who were just friends, and they just talked on the show. And then he started interviewing scientists, started interviewing authors and actors and all this stuff. Lo and behold, he became the most famous and the biggest podcast in the world. And he gets like 190, 200 million downloads a month, which if you have any idea what that means, that's an insane number, okay? A good, strong podcast would get like 10 million downloads a month. That's a really good podcast. Joe Rogan does 20 times that. So the normal ways of doing podcasts, I believe Apple has the lion's share of, correct me if I'm wrong on this, you guys too, but you guys will get the idea, is that Apple does like about maybe 60% of all the podcasts. So people who listen to podcasts just go to Apple Podcasts. And then Google Android does about 25%. And then the last little small percentage is just everybody and anybody else, all those little smaller platforms. Spotify just went out there, who's been making huge gains in the last 2 years. They spent $400 million buying up podcast studios. Do you call them studios? Podcasts, basically companies. So the two most recent ones that I remember is The Ringer, which is like a sports podcast. Think of ESPN, but for podcasting. And they bought out Gimlet, which makes like, I actually listened to a couple of Gimlet ones, like Wolverine, and they have those cool story podcasts. They have like, I've listened to a couple of Dungeons and Dragons, I know, super nerdy, right? Wolverine, Dungeons and Dragons. But Gimlet produces or is a part of those podcasts they help make those. Spotify bought those. Spotify also bought another one I can't think of right now. And just as of last week, which is totally insane because Joe Rogan, everything says that he's not a company man. He doesn't want to work for anybody. By the way, he doesn't work with anyone. It's just him and Jamie, who's his producer, and he owns 100% of his podcast. He doesn't censor it. He doesn't do anything. He talks about whatever he wants. If you are you're not shy and you don't get offended very easily by bad words, it's awesome. Think about Howard Stern, but with a little more tact. Not as raunchy as Howard Stern back in the day. That's Joe Rogan for podcasts. Spotify came over and signed him up exclusively. So they're taking him off YouTube, taking him off Apple. And the large reason behind that is because of censorship. And most of you guys know YouTube, Facebook, Instagram, Twitter, Apple has had a lot of heat for censorship issues, right? Right or wrong or indifferent. Whatever your stance is on that, is they've had a lot of flack. And a lot of reason is because if they drop an F-bomb or they say a bad word or they even broach a subject, not even saying facts or false facts, false truths or whatever, just talking about the subject will get them delisted, demonetized, or what do you call it? Or it's called shadow ban. Well, basically the algorithm can't find you. And that's probably why nobody knows about my channels, because I was shadow banned for all the cool things I teach you guys. Just kidding. But anyways, so YouTube does the same thing. So YouTube basically demonetizes almost, I'm assuming a lot of Joe Rogan's videos, because there's a lot of cursing. They talk about sensitive subjects from anywhere from racism, Russia, China, the coronavirus. Think about anything that's abortions, Republicans, climate change, all this stuff, Bigfoot. So what ends up happening is that they demonetize him and they censor him. Spotify says, hey, come over here, put your videos on our network. We'll host you, so anybody who wants to listen to Spotify can listen to you for free. Keep all of your ads, and then on top of that, you get to keep your ads. We'll pay you money for the ads that we show on it, and on top of that, we'll give you a nice little nut for you coming over and just staying with Spotify, which the rumors are around $100 million plus for, it doesn't say how many years, but for multi-years. So let's say it's even a 3-year contract. $100 million, that's $33 million a year, plus all of his ad revenue, which is probably in the range of 30 to 40 million a year. So he's basically making $100 million a year now as a stand-up comic doing a podcast. It's insane. It's so insane, but it's awesome. I'm happy for him. He's a super cool guy, and I really like him. But let's take a look at Spotify. The thing with Spotify is that they're making moves, and they're a growth company. Remember, with growth companies, Tesla, Twitter, Uber, Lyft, right? These unicorns, is that they give up cash flows today for growth. So growth today, cash flows tomorrow. That's the mantra. Growth today, cash flows tomorrow. And what you're doing is when you invest in a growth company like Spotify, is that you're saying, I am willing to risk my money because you have no evidence, you have no proof that you can actually make money, but I believe in you. Amazon is another one, is that you can grow into making profits, and not just making profits, but making consistent profits that will eventually keep on growing over time. And that's what your investment gets you, is you're buying into that promise. But a lot of times people get burnt real bad from growth stocks like Groupon. You guys remember Groupon? But there's a lot of them that have done that. Remember WeWork? WeWork was just super bad investing, but they weren't even a public company yet. They were supposed to go public, but they didn't. All right, enough chitter chatter. I talk too much. How do you guys even listen to me? All right, so let's jump down here. We are doing Spotify. So the first things first, let's go into, I got to fill out my assumptions here. I got to change this Spotify. Ignore all of this over here for right now, okay? That's not correct. So the current stock price of Spotify, let's do this one at a time. What is it? It was like 190. 190.17. Current PE ratio is, I just saw it. Ooh, that is high. Well, at least it's positive, right? Let's go into cash here real quick. Let me make this a little bit smaller. Can you guys see everything okay? Let me make sure you guys can see that. I think it should be okay. All right, so cash, they have, come on, there you go. Cash is right here. They have 1.68, Remember, that's investor cash. That's not their, maybe it could be the cash. I haven't looked into it. I shouldn't say that. Their debt, oh, wow, they don't have a lot of debt. That's good. Their investors would not probably let them, so that's fine. Tax rate, we don't know yet. Average interest on debt, we do not know. Now, discount rate and EBITDA multiple. So these two, I should really start highlighting these two. These two right here it's the bread and butter of my method of valuing stocks. And the reason why you need a company to be profitable is because these two numbers apply it to their cash flows. And so you can imagine if your cash flows are negative, you can't really value them, right? It's like, how do you value negative $17 billion in cash? You can't value that. And it's like, next year, we're only going to lose negative $9 billion. And it's like, I can't value that because you're a negative company. And so that's considered speculative. And that's when investors go into other methods or strategies of investing. I don't like those other strategies. I don't like those other methods because I'm not proficient in them and I don't really understand it. And I don't really understand companies that don't make some sort of profit. With that said, that's why I only invest in these type of companies. Like they only make up about, I think it's like 8 or 10% of my portfolio. So first thing is discount rate. Discount rate is basically the risk rate. Risk rate, as you guys know, is whatever the current interest rate is, right? If you just put your money in the money market account and then you add a premium or a risk premium, like how risky is this stock? How risky is this company? So right now, I think I'm getting like 1.5% in my money market account. So we'll say the baseline is 1.5%. And then risk premium for Spotify is like, what is it's like, how risky is this company to continue to grow? Like, could they go bankrupt? Are they going to get smaller? Are they going to miss projections? Are they going to have like an ousting of the leadership team? All that stuff, right? Like what we saw in like Airbnb right now is a very risky company, right? Same thing with Uber and Lyft. Those are both very risky companies right now. Spotify is a little bit different. Spotify is from a personal perspective, anecdotally, is I know a ton of people that use Spotify. I know they've been growing like crazy. And I know that they just spent a lot of money acquiring Joe Rogan. And just to put it in perspective, before you guys feel like really happy for Joe Rogan, just like can't believe it. If they paid him $100 million, the next week their stock price went up like a $2 billion. So they're making out just fine. But I think their discount rate, just to give you guys an idea, 1.5 right now in this market, 7% is probably baseline. I'm going to give them a little bit higher. I'm going to give them an 8.5% discount rate. So what I basically just said is I'm going to use a baseline 1.5 and I'm giving them a 7% premium or risk premium. Okay, so to give you guys another baseline, so like a company that's really solid, like say like a Costco, right? Super stable, entrenched in our system. They've been in the stock market. They've been publicly traded for decades. I gave them like I gave them like a 4%. 4%. So this is basically double. EBITDA multiple is how many more years do I feel comfortable forecasting out the last year that I projected out. So right here, I'm projecting out to 2024. EBITDA multiple is basically this. Remember right here, you guys, a lot of times the terms that I use is just fancy business jargon. I barely even use it. I just use it because I was trained to. This is EBITDA right here. It's basically you take out the cost of goods sold and you take out the cost of salaries, lease or payments of payroll, insurance, printer paper, ink, that type of stuff. You take all that out, how much money is left over? That's all it is. And what this multiple is how many times do you multiply by this, right? So in this case, it's already at 7. You're multiplying this out by 7. You're saying that for another 7 years, so until 2031, we think that they can make at least $75 billion. These are not their numbers. I got to still change them. But you guys get what I'm trying to say, right? So Spotify being a newer company, I'm going to give them a lower multiple. Lower multiple means lower valuation. But I don't know, because who knows? What if they take over the podcast scene? They could, in theory, completely change how podcasts are viewed and how podcasts are consumed. So in that case, we would have to give them a high multiple. But at the same time, they're super risky, right? They are barely profitable. I'm looking over here. Actually, they are profitable. They're actually not doing too bad, you guys. They're a growth company, but they're actually spitting out some cash. $570 million last year. That's not bad. That's not bad. EBITDA multiple, I'm going to give them 5. So what that means is that I'm going to forecast this out to essentially 2029. Okay. So 9 years out. All right. So let's go in. Now we go in and we start plug and chugging income statements, balance sheets, and everything. And we can all access this. You don't have to pay for this. This is all free on Morningstar. I'm not sponsored, but if anybody knows Morningstar and wants to tell them to sponsor me, heck yeah, sponsor me. Just give me a free premium account so I don't have to pay like the $200 or $300. That'd be awesome, right? All right, so I'm exporting this to Excel. I'm just gonna copy this right quick. Ooh. Copy. I'm going to just plug it right in here. Are you guys still inside the chat room? I haven't seen anybody write anything for a while. Maybe you guys are just quiet, but I don't want to make sure that it's not all messed up again. I'm going to open up this one. Jens, you guys still in the chat room? Okay, cool. Thank you. And then last one is statement of cash flows. I'm going to pull that over. Oh my goodness, we've been on here for an hour and a half already. Oh my gosh, I'm not getting any work done outside, but I love you guys so much. Okay. What's going on with my cursor? All right, that's big enough. I'm going to open this so I can actually work in this somewhat proficiently. Whoops, didn't mean to do that. All right, so let's clean this up. Boom, 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 boom. Nice. Okay. Ugh. Whenever I see this is not good. A lot of NAs. So let's go through here. So now I have all these formulas up, and the reason why I don't give you guys a spreadsheet is because it has all these issues in it, and I'd hate to give it to you guys and then have these issues pop up. But so now what I'm going to do is I'm just going to go through here super fast and just see what's going on. So depreciation, they did not put in their income statement, which is sometimes the problem, is that not all companies do it the same. So let's go over here. And they put it in their statement of cash flows, which is fine. So we'll just go over here. I just fix this right quick. Copy and paste. I'm gonna go over here. Come on. I'm gonna move it right here. And this is from A to AK, or what is that? AE to AK. So all I'm doing right here, everybody, is I'm just playing with the... Oh, come on. It's still not pulling it. What's going on? AE. Oh. I'm just playing with this formula so it pulls, because I have this automatically pulling, and I didn't do it right. AE to AK. Did I not do that right? Oh, that's why. You guys, I need to sleep better tonight. That's what I need to do. I'm sorry, you guys. I'm so sorry. Okay, don't mess with that one right here. AE to AK. There you go. All right, bring that down. Now we need to just go boom 6, 5. So Spotify did have an issue in the past where they weren't paying their artists a lot of money. So I'm wondering how that shook out. Okay. Principal payments. Let's go make sure that... Well, they didn't have a lot of debt, so I doubt... Yeah, they just had debt back in 2016. They paid that. Nope, that was an issuance. So they took 861 million in debt. So they didn't pay it. They didn't pay anything. So they're still holding on to that debt, it looks like, right? It must be. So this is the statement of cash flows. This is the balance sheet here. And so what I'm doing here, everybody, sorry, I'm just bouncing all around, is I'm just double checking, making sure everything is accurate. So there's long-term debt. And this is basically what I would do if I was like looking at one of your guys' like balance sheets. And remember, balance sheet is just basically the assets to your liabilities. And then statement of cash flows is basically just what it sounds like, is that they are how much cash is going in and out of your accounts. And so I'm just confirming everything because their income statement, which most people pay attention to, that's what usually has like the revenue and the earnings and everything, all the sexy numbers. But you want to pull numbers from everything so you have a better idea. But I'm going to keep things easy and simple for right now. I'm going to get rid of their debt payments because it doesn't look like they paid anything. Let me just double check and confirm that. So they had some debt. Oh, that's not even debt, you guys. So you guys see, this is why it's so important. So look at this. This is why it's important to read the financials. So if you go to here, nope, not there. You go to here, financials, and you go to here, right? You see this? Total debt, 0.62. We thought they had $620 million in debt, right? But when we go into their actual books, and this is the story I'm talking about. This is a great example. As I look at their long-term debt, you're like, what is going on? They don't have long-term debt. This right here is 2016. This column right here, 2016, 17, 18, 19. And there is a $622 million of debt. But do you see what it is? It's capital lease obligations. Capital lease obligations is basically you're leasing something. In this case, it's probably property. Or I just thought it could be music. Could it be music? Either way, lease and debt is similar. You owe somebody something, okay? That's absolutely right. So in this case, let's say that is for a building. I would have to dig into it deeper. But let's say that this is for, it's like a 10-year lease on a building or something like that for their home office. It doesn't come with an interest rate. It doesn't come with a dead end period where they have to pay it all up. It's an expense. You just keep paying down that capital lease. I don't like treating it like debt because if they go, I mean, I guess technically you do, but I don't consider that debt because there's not an interest rate on it. There's not a clicking talk. There's not a ticking clock on it like debt does, especially current or short-term debt. So in this case, I'm going to say that they have zero debt, okay? Just to play it nice and easy, nice and simple. No debt. Now, what we're going to do is we're going to wipe out long-term, short-term debt. And so right off the bat, we look at their core business. We can see that they are profitable, which is a good thing. So last year, they made 80 million. Now we can see when we do this, you see how nice and easy it is and see how fast that they're growing? And let's see how fast their growth rate is. Look at this growth rate. This is the thing about growth companies, is they grew revenues at, I'm actually interested to see how fast they grew unlevered free cash flows. 52%, 38%, 28%, 28%. And then look at this, their unlevered free cash flows, which is this line right here, which is basically cash flows from their operations, has been growing as well. So the percentage of their cash flow has actually been increasing over the year. So they're keeping more of the revenue, which is a very, very good sign. And these are the growth. You'll never see this in a Costco or an Intel or like a Walmart or anything. Those are value stocks. Those are stocks that grow at a steady 3 to 7% a year. Growth stocks are expected to grow like this. The only thing that kind of scares me a little bit is that growth stocks should be growing really fast. I would argue even faster than this, which they could be. For 2020, especially everybody in lockdown and everybody just stuck at home, podcasts can be consumed way faster, especially if they get Joe Rogan, and Joe Rogan has a lot of friends in the podcast scene. If they all jump ship and go over to Spotify, we could see this number jump up. Like, you guys got to think, Spotify is in a realm where they can shift the game, like how YouTube is for videos that you guys want to watch, like this video, right? Instagram is for cool images, quick little stories and such. TikTok is for dance and goofy, funny little 15-second clips or whatever. Spotify could be the new space for podcasts and podcast videos, right? And if they do that, we could see this jump. And we know how much YouTube, we know Instagram and Facebook, they make a ton of money off advertising. And so if Spotify is able to advertise on Joe Rogan, right, and he gets like 200 million upload or downloads, they would be making a lot of money. That's just off one podcaster. Imagine if they had multiple, hundreds, thousands, tens of thousands of podcasters. They could be the next YouTube. That might be out there. But yeah, they can see that growth. So let's go play with the growth a little bit. So I'm gonna say, let's keep their growth. I'm gonna say that they're gonna grow at 30% this upcoming year. And then I'm gonna say that they're gonna jump up at 50% because they're gonna get a bunch of new podcasters. This is totally arbitrary, by the way. So this is not an exact science for me right now. If I wanted exact science, I'd have to dig deeper into their annual reports. And then let's keep this going, and let's say that they grow. They start slowing down growth after that next year. No, let's say that they keep going. Let's say they keep going another 35, and then they start slowing down, and they get down to 20 and 20. Okay, there you go. A little bit more modest. And then let's just go through here and make sure that these numbers are right. And then we go double check all of our expenses. So you guys see, I have this formula in here where it takes the median of their expenses of COGS, and usually it's a percentage of revenue. And this percentage of revenue started at 88%, went down to 86, went down to 79, went down to 74. That's why we see their cash flows growing. But this is at 74 for the last 2 years. I'm going to be fair to them, and I'm going to say, you know what? It'll be 74% the next 5 years as well. We're going to do the same thing for SG&A, which stands for sales, general, administrative. So it started at 16.75, 18.20, then went down to 17.17. I like that. 17.45 is perfect. I feel good with that. Depreciation. Let's see, where are they at? Depreciation is right at 1.5%. I'm okay with 1.29. Working capital. Let's see what they're doing. Working capital. If you guys remember, working capital is why did I do? Oh no, that's CapEx. That's CapEx. I'm sorry. CapEx 0.9. So I'm not going to keep 0.9. I'm going to keep it at 2% because it looks like they've been spending a lot of money on growing, which makes sense. And then working capital. Wow, they've been positive working capital? How do they keep it positive that much? I'd have to dig into that. Working capital very rarely stays positive. It usually fluctuates a lot. Working capital is accounts payable, accounts receivables, and inventory. So for them to have positive working capital every single year, that's impressive. I don't think it's sustainable. So I'm going to lower this down to 5%. All right, so we do that. Boom. Let me make sure that these numbers are on target. I'll just jump straight down here. 1.5, 0.5, boom, 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 boom. Okay, I'm down with that. We're making a huge assumption that they don't take out debt. I don't think they'll need to. Hopefully, if they run things well, they don't need to. All right, let's go see what they're valued at. Oh, My mistake. $2 a share. I wish. That is a cheap stock. If you get it for $2, I can tell you that right away. No debt, spitting out, what is it? Cash flowing $800 million a year. I forgot to put in, where is it in here? I forgot to put in their shares outstanding. There you go. There you go. 0.18595. Boom. So, based on my assumptions, they are overvalued, which makes sense because they were just at what last week? What was it? They were like 135, 140 before they announced Joe Rogan thing. That's about right. The market right now is so overvalued, but let's play with this a little bit. Let's just go insane. Let's give them a better discount rate. Let's give them a discount rate of like 6.5. Let's give them like an 8 multiple for EBITDA. And then let's blow up their growth rate. Let's say that they grow at like 50%. Let's even get crazy, say 65% next year, and then they start to taper off at 50%, and then they level out 35 and then 30. Okay. So now you can see we know what their expense ratio is. We know what their tax ratio. Did I do their taxes right? They've been just losing money. Taxes. Let's give them a different tax rate. I don't like that tax rate. Let's give them at least like a 5% tax rate. So for us to get even near where they're valued at right now, these are the assumptions this is the story that we would have to tell ourselves, is that they're going to grow by 50% this year. Keep in mind, they've been growing at, the last time that they grew at 50% was back in 2016 when they first, I think this is right around when they went public. Right? It was 2017 maybe they went public. Anyways, let's say with the podcast game, they were able to grow out 50%. And then next year they have a whopping 65% growth. And then they grow again at 50% because this podcast is going crazy. And then they start to level out as a growth stock. And they start growing at only 35 and then 30%, right? This would be insane growth. Absolutely insane growth for a company, okay, for that many years in a row. And then we give them 8 times. They're able to go all the way out to, we think they can do this all the way till 2032, okay? They can keep this up until 2032, and then we are only discounting them 6.5%, which is on par for companies like Disney would be somewhere around there. Who else would I put around there? PayPal. I'd probably put Home Depot around there. Boeing, Apple, Starbucks, I'd put up around there. So if I put all those up there, I can get to their current price right now. But I do not think that. I really think even at 7.5%, and let's do like 6 times multiple. Let's bring these down a little bit. This is what I think is more realistic based on what I see. What did I do? 30, 20? Yeah, we can go with that. Either way, story of the game, they're overvalued. Which is not, don't worry, it's not just Spotify. It's the entire market. The entire market is overvalued right now. Remember, if you guys listen to my last live stream, is that the current market, our stock market right now, is 12%. Is it 12%? I think it's 12. 12 or 15% more overvalued than last May when we already knew the market was overvalued. All the investors knew that the market was overvalued last May. It is even more overvalued today. It's kind of weird, right? Now, we just walked through this, and now you guys get to see exactly why it's so hard or so difficult to value companies that are considered growth companies. It's because it's hard for us to predict what they're going to do the next 5 years, let alone going out 11 years, right? These 5 years plus the multiple. And the reason behind that with a growth company is because, as you can see right here, their growth is all over the board. They are just throwing out cash, hoping to grow that top line revenue, right? Costco doesn't have to do that. Costco's not going out there trying to buy Walmart or trying to buy a Home Depot or trying to get exclusive deals with one celebrity. That's not something they're trying to do. They're just trying to stick to their core business, service their customers, treat their employees the best they can, and continually grow at a reasonable rate that has been done for the last, 15 years, right? Companies like Lyft, Spotify, Tesla, Facebook. Facebook's getting a little bit more entrenched, but Tesla for sure. Amazon is still in there. These growth stocks, what they're trying to do is they're coming out with new items. They're buying companies. They're spending cash like crazy. They're pulling crazy amounts of investor dollars to try to fund these projects and these while they're in this growth stage to hopefully become profitable. Spotify is just a great example because they actually are profitable. They've been profitable, which is phenomenal. And that's one of the things what I really liked about Airbnb is that Airbnb hasn't gone public yet, but before this year happened, and I bet you they wish they had gone public before because they just took a huge hit in valuation by not going public, is that they've been profitable. They were, I think, $100 or $200 million in profit last year, which is really good for a company that's in the growth stage. So Spotify is doing the same thing. That's awesome. I just want to check something real quick. I want to see how many shares. Okay. So you guys see right here, this is another story. Boom. Let me highlight this. You guys see this right here? I want to see how they are actually funding this, how they're funding this growth. So buying Joe Rogan, buying all these things and making sure that they have cash. They sold the equivalent of, what is that? No, that's common shares. Right? Wait, how many shares total do they have? What did I say earlier? Yeah, okay, 195. So they sold shares, basically, to fund their growth. This is 2018. So yeah, they must have been gone public in 2000, right around 2018 then. So they released 180 at the end of 2018. And what did I say? Well, they have 195 now. So between then and now, they released about, let's say, 15 million. Let's do some really, really, really rough math. Is that 15 million? 1, 2, 3, 4, 5, 6 times. Let's say that they released it at an average. Let's say an average of like, let's make it simple, $100 a share. Okay, that's simple. So they basically had, what is that? 1.5 billion. So they raised 1.5 billion just by releasing those 15 million shares. You guys see what I mean? So it diluted the shareholders a little bit, but in the long run, it was able to work. Because look, just between last year, what is this? This is 2019. Till now, they released 11 million shares, which is if it was trading at $100 a share, that's 1.1 billion. That would be enough. That's 400 million to buy those companies, right? And then another probably say $100 million to get Joe Rogan. And then they probably have another couple $100 million out there to go try to snag up everybody else. What this is going to do for us, though, as consumers, is that we're going to hopefully get better service from YouTube and Google and Apple. You see this story that we can weave just by looking at numbers? I love it. It's one of the best things that I get from this is that I know a lot of people, and I still do, is you look at this and it's really confusing. All you see is just like this, their current assets, accumulated depreciation, da-da-da-da. And then you see these huge numbers sitting next to it. Once you do it enough times, you can pull a story out of it. It's really, really cool to see. So like right away, I didn't know when they went public, right? But just looking at common shares issued, I could see 0, 0, 0, boom, 181 million shares. So like, oh, they went public somewhere in this year, this time period. And then now I know they have 195 million shares. They started 181, so there must have been, why is there a change? And then we see a change here. That was about 3.5 million shares. And then now, we know 195, that's about 11 million shares off. And then you can put these stories together where I'm like, oh, that's how they raised all that money. They raised 1.15 million or $1 billion. And then I know they just spent probably 500 million of it purchasing all these other podcasts. And so you do that, and then you dig into their annual report, and then you listen to their earnings calls, and you can create a really cool backstory and understand, is this company worth investing in? And that is what I believe is a true way to invest in companies. And this is what I did for I'll tell you the companies that I'm super interested in. I haven't purchased them yet. I'm gonna start buying them up when this next this downturn happens. Is right now. Here, boom. Home Depot. That's one. Super overvalued right now. They're like at 240. I'm gonna buy them once they dip. I think they're gonna dip way below 199, but I have them valued at 199. I'm gonna buy a ton of Home Depot. I'm gonna buy Disney. I should be buying Disney right now, but it's just. I tell you guys this. Don't listen to me. I tell you guys not to time the market. I should be buying into Disney right now because they're currently trading at like 118. This is old. I have valued at 141. But with their cruise lines and their parks, it makes up almost 40% of their revenues. Oh, that's horrible, right? And they're all closed. And so I think with the market so overvalued, they have a long ways to go down. I think I can get in cheaper. Don't listen to me though. That's bad advice to tell you. Try to time the market. Okay. Intel, I'll be buying in. They'll be one of my staples. Boeing, I will be definitely getting into. I like Boeing. They are considered a value stock, but it is a riskier value stock considering the context. I'll definitely be buying Microsoft, Starbucks. I'll be getting into. Waste management will be another staple of mine. Caterpillar will be like my risky value stock. Into my riskier ones, Planet Fitness I like. I don't like them at the price that they're at right now. But if they dip down below, I'd say 35.30, I'll definitely jump in. Now, my big ones that I really, really want, especially in this next dip, I just feel like we're going to see a huge crash here, is Chipotle, Nvidia, and Costco. Those are my three big ones. Chipotle is just crazing at an obscene. I mean, when I did this, I talked about Chipotle. What was that? 2-3 weeks ago? They were trading at $8.78. They're at almost $1,100 a share now. All right. I still stand by it. No, I shouldn't have bought into it because it's bad fundamentals. I will not overpay that much money in this volatile of a market. And then I even told you guys Amazon was a good deal. I didn't buy it because I thought Amazon was still so overpriced at $1,500. They're trading at 20. What are they trading at? 24, 2,500. It's never a good deal to buy into something that's already a bad deal and it goes up. I mean, you can, but you kind of go against business fundamentals in that case. Because what happens if Trump said something, an outbreak of coronavirus happened, and lockdown is extended 2 weeks, right? This all could crash because the only thing that supports this number here is this. That's all that supports it. And this tells me it's valued at this. Not at 878 and definitely not at whatever, 1,060 or whatever. Nvidia is the same thing. Nvidia right now is trading at peak levels. They're at 360. Pre-COVID, they're trading so high and they barely make any money, right? They're at trading, I think, what are they trading at? They're trading at like 83 times earnings. It's so insane. So anyways, that's pretty much it. Oh, O'Reilly. I like O'Reilly Auto Parts. They're significantly overvalued right now, though, too. I would buy them if they drop down significantly. Other than that, don't buy Budget. I don't know enough about DocuSign. JP Morgan could be a good one. Qualcomm, I don't know enough about. Marriott, I like. At, they're at $81. I think they're trading at $90 right now. I'm gonna keep an eye on them. But other than that, that's Spotify, and that's a growth stock. So hard to predict what they're going to do. Growth should be number one. They should be losing a little bit of money or just spending an extreme amount of money to be able to grow. And so we'll see. I think it could be a next big thing. And I think if you are open to speculating, and if I were to do it, if they went and dropped below like around the $100 mark, I'd definitely buy into them, knowing that it's a risky stock. This is not a value stock. Do not make a whole. The worst thing is to make your entire portfolio Spotify, Facebook, Uber, Lyft, Amazon, and Tesla, which I see all the time. You don't want to do that. Those are all growth stocks, and the chances of them going in half is very, very high. You want stocks that are super stable, good, like Costco, Home Depot, but not Boeing. Boeing's a bad example. Microsoft, that type of thing. And then you sprinkle in some like maybe REITs. Like I like Realty Income. They're actually trading at a very fair value right now, and they actually have a decent dividend. That's good too, right? So you get a little bit of the real estate play, and then you also get the dividend play, and you get the stock market, the stock play. So, all right, always learning. Okay, waste management. Where was it? Waste management. I have them valued at 110 actually, and I believe if I'm correct, I'll look at this real quick. I have them with they have a decent dividend, I believe. They've been trading sideways this whole time, but they're pretty consistent. They've got an okay dividend. They've got a 2.2% dividend. Let's see if anything's changed for them. They've got some good cash. Debt is okay, nothing crazy. But their operating cash flow is solid. They're able to address their interest and loan payments just fine, it looks like. So, yeah, waste management would be something that I would go in the long run, and I would just hold on to. I wouldn't expect huge gains. Let's see what they were trading at their 52-week high. Well, actually, it says right here, right? 52-week high, they were trading at 126, 120. Yeah, so they're still pretty close to their low right now. But again, everything's overvalued. I'd say, even if you discounted mine, 109.84. Yeah. Well, let me look at this for you guys real quick. Let me see this. All right, so here we go. Sorry, jumping back to. Hang on, always learning. I'll jump into waste management here real quick. But Spotify's at 150. What'd I say? I had them at 116. Boom, boom, boom. 107. Okay, so they have them at 150. They have them below 190 as well. Let's go over to here real quick. Spotify valuation. Look at that. So we're all in the same range. So and then over here, you look at Simply Wall Street. They have them valued at 135. I'm at 107. Morningstar is at 150. So that's all about on par. Let's take a look at waste management real quick. And then I'll let you guys go. I got to get back to work. Waste management is 81. What did I say? I had them at 110. Ooh, so I'm really bearish. I'm optimistic about them. Let me see. I'll have to dig in deeper. I wonder why I'm so far off. Let me jump in here real quick. Waste management valuation. Yeah, they've given good solid dividends for a while. So waste management, I have them at 110. Morningstar has them at 81. And Simply Wall Street has them at 95, 96 bucks. Okay. So we're all in the same range. They're trading at around fair value right now. The thing about the next, when the market dips again, is that everybody's going to go down. Now, when you guys hear me talking about this, I am completely speculating about the market. All I have is like what I see in the numbers and the statistics that are in front of me, and then I try to make an educated guess or decision on it. And right now, I know when the market dips, even great companies, Chipotle, Tesla, Costco, Home Depot, Microsoft, Apple, everybody goes down. The whole market gets depressed. They might be higher than everybody else, but the whole market goes down. And I'm banking and betting so much so. I mean, I'll share this with you guys right now for the few of you guys who are still in here. If you guys want to see, is that my portfolio, the only thing I have in my portfolio, I sold everything off. So this was a lot higher just a couple days ago. But this is my portfolio that I used for you guys. And I sold off all my stocks, so most of my cash is sitting in my TD. My main account is TD Ameritrade. It's sitting in between my money market account, my TD Ameritrade, and I put over 20. I had $28,000 in here, and I'm buying. I am not telling you to do this. This is just me, how much I'm betting against the market. I bought these call options right here on SPXU, and what these are these are highly risky options. And what they are doing is that This is an ultra short of the S&P 500. So what that means is that it constantly bets against the S&P 500. So normally if you buy an index fund, the S&P 500 goes up, right? I bought call options on an ETF that bets against the S&P 500 times 3. So it magnifies whatever's going on, the inverse of the S&P 500 times 3. So if the S&P 500, let's just make this up, goes up by 3%, this will go down. Sorry, if S&P 500 goes up 1%, this will go down negative 3%. Okay? If S&P 500 goes down 1%, this goes up 3%. Does that make sense? So I believe that the S&P 500 is going to go down in the long run by so much that I am buying call options, which is betting that this will go up. So the S&P 500 goes down, this will go up, right? So you can see right here, if I just take this out real quick, 1 year, you see how it's going down because the S&P 500 during these times has been gradually growing. And then all of a sudden March hit and it peaks out. Right? It goes from, what is it? It goes from like $17 up to like $41, $42. Yeah, $41. And then it starts growing again and it starts repeating. So then it starts going off. I have my call options all the way out into 2022. And next summer is when I'm betting that the market's going down. It is so super risky, and only do this with money that you're willing to throw away or that you're okay with. And so right now I have a couple $1,000 tied up in it. I think I only have like maybe 3,000 or 4,000 tied up in it. And I'll keep buying more as I see the market get more and more crazy because I am betting so much that this market's going down. I mean, like, look at some of these prices. It's so ridiculous. Apple's at $319. Tesla's at $817. Netflix is still one of the most overvalued companies at $430 a share. Look at it. Fiberglass. Facebook's at $234. Disney's at $118. That's actually kind of fair because I did value them at $141. But for $118 for like basically most of their businesses shut down is ridiculous. Look at Amazon's at $2,400. Nvidia, this is probably the nuttiest one I've seen, is at $360. I get it. They're a good company. They make, I get it. They make graphics cards and people are wanting graphics cards right now, but they're so overvalued. It's like, I get it. Yeah. Give them a fair value. Even at $200, I get it. I don't understand $360 though. That makes no sense. So let's see. Who else do I got on my watch list? I've got Love right here. That's Southwest. Be careful. They're dangerous. There's Delta. AT&T is a good stock with decent dividends. They've been fairly consistent. JP Morgan is actually trading at a very fair value right now. Costco is really high. Look, this is the other one. Super overvalued. Chipotle. They're trading at almost 2.5 times more than I think that they should be trading at. Other things like gold. I wouldn't even talk about gold. I have so much I want to talk to you guys about. I'll be buying more gold. A good gold one to look into, you guys, is GLD. There's another one. It's just a gold trust. It just covers gold prices. I'll talk more about this in my next video too. It just tracks gold prices, and this is just a good way to really kind of, I talk about investing defensively. It's also called diversifying. It's diversifying. So you have some stocks, you have some precious metals, you have some Bitcoin, and then you have some in cash. You have something super safe like in the money market or something like that. And so when you do that, when there's huge hits or declines, you're relatively safe. But in the long run, everybody should be a long-term investor in some capacity, is that you win, right? So if you invested this back in even 2019, let's go back a little bit further. You go back here, all the way back 5 years ago, at, what is that? 115 to 160, 170? Yeah. So you win a little bit, small portion of your portfolio. I'll probably be putting about 10 to 15% in precious metals. So anyways, any other questions? Let's jump over here real fast. What's up, Kenny? Where do you get this Excel? This Excel file is just mine that I use to show you guys, and I walk you through it and I talk to you. It's not available yet because, like I said, when I was pulling it up, it has a lot of errors. Not errors, but it's really finicky, and I have to, a lot of time on the fly, I have to fix it. So hopefully I'm teaching you guys what to look for, and then you guys can create your own, or at least just go through the financials yourselves. Paradox. Oh, you just told me your name. What was it? It was Cedric. Was it Cedric? Yeah, Cedric. Okay. Oh, I didn't even see this. Manuel, I got like 5 shares at 32. I think it was cheap then. It went down even more. Yeah. Manuel, which share would you buy? Oh, Spotify. Nope, not Spotify. I don't know what you're talking about at the 3208. Sorry, I missed that one. Cedric, I can really recommend German company BASF. Take a look into it in a free minute. Very solid, still too expensive. What is that? Now you got me curious. BASF. Did I write that right? Oh, it's a German company. Okay, I'll have to take a look at it. Are you from Germany, Cedric? My good friend's in Germany. Or he's from Germany. Always learning. There's a Bitcoin ETF. What's the Bitcoin ETF? Let me see. GBTC. How come these aren't coming up for me? GBTC. Oh, there it is. Yeah, I just need to learn more about cryptocurrencies in general. Ooh, that looks volatile. But I guess Bitcoin is volatile. I guess this is a cheaper way of getting into it and just how you trade it. I don't know. I think Bitcoin is something and less of an investment. It's just pure, to me, it's almost like gambling. And I just buy into it, believing that it could eventually go up. Just a small portion of my portfolio. I probably put like less than 1% or 2% into it. Until digital currency becomes, I think that the U.S. government or somebody else, whether it's a Facebook, an Apple, or Google, they're going to create something using that technology that will be better. But in the meantime, or along the side of it, I think Bitcoin is just going to be, it's going to go along for the ride. But I don't see, and I could be completely wrong, I don't see people fundamentally using Bitcoin as an actual currency. I think that they actually hold on to it as either a wealth generator or they hold on to it just as a holder of wealth, a wealth holder, if that makes sense. I don't think most people are not using it day to day. They're not using it like a dollar or a yen or won or, Oh, cool. Yeah, my buddy's he's from Hamburg. He actually lives in Guatemala now, but my buddy Johan is from Germany. I'm not sure where southern Germany is. Actually, I need to visit. I heard Germany is really cool. All right, my dudes and dudettes, that's it for me. I told you guys I was going to be here for 45 minutes to an hour, and you guys got me to stay for a full 2 hours. Good job. So, if you guys have any questions, hit me up. Find my Facebook, or not Facebook. Oh, I'm so tired. I'm losing it, and I